So, the methodology. Fundamentally, the Nexia Global Growth Insight Survey is a study of the mindset of growth leaders. We canvassed a hand-picked cohort of 179 mid-market companies from our members' client database. And these are genuine middle market participants. 80% of them have an annual revenue between 5 million and 1 billion US dollars. Combined, they represent an employee headcount of over 200,000 people worldwide. And at the time that we released this survey, it was in Q1 of 2026, around the time that the Strait of Hormuz was effectively closed by Iran. So there are a few external things going on right then and there. So I'm going to tell you a story of what the results from this year's survey tell us through the lens of 5 headings: ambition, capital, capability, complexity, and advice. So, if we look at ambition, 54% of our survey respondents stated they had an ambitious growth strategy. 61 of those were targeting 5 to 20% of growth. And 83% of our respondents are confident of delivering their target growth for the year. We speak about measured growth in our report. Measured doesn't necessarily mean cautious. These businesses are ambitious, but what we're seeing is perhaps a more disciplined definition of ambition. What I find interesting is the relationship between these numbers. More than half describe themselves as ambitious, yet most aren't talking about doubling their business overnight. For the middle market, ambition seems to be more sustainable. It means achievable expansion rather than growth at any cost. And perhaps those numbers aren't contradictory at all. The fact that businesses are setting more achievable targets may partly explain why the confidence remains so high. There's a discipline here. Ambition is being calibrated against what management believes it can actually execute. This is perhaps mature leadership set against wider external factors upon which Sol and Bob will discuss later. Capital. So capital dominates a lot of economic conversation, but that's not necessarily what we're hearing from the middle market in this year's research. 7 in 10 believe they can access the funding that they need, and 3/4 don't regard capital markets as particularly significant to their growth prospects. When asked what they need to deliver growth, access to capital ranks 6th, behind team capability, stable operating costs, leadership bandwidth, access to talent, and a favorable macro environment. And dare I say, if we look at the other side of that equation, there is significant capital in the market looking for somewhere to go. A recent McKinsey report states that more than 40% of deployable private equity dry powder has now been sitting for at least 2 years, waiting in the wings for it to make its appearance. Access to capital doesn't appear to be the binding constraint for our growth leaders, certainly in this year's research. So, ambition appears to be there, and capital appears to be there. What might be constraining our middle market clients and our middle market participants? Capability. So when it comes to talent and capability, our research states that 57% of our cohort are confident that they can attract and retain talent. Yet, team capability is the #1 enabler of growth. So what does that possibly mean? Perhaps the issue isn't getting people through the door. It's whether the organization has the collective capability to turn ambition and investment into growth. A business might be able to recruit, it may have funding, and it might have a very good product or service line. But can it generate demand, convert opportunities, integrate acquisitions, use technology effectively, and scale without destroying the current economics of their business? Something else I find quite interesting is that sales and marketing capacity was ranked as the #1 internal growth factor by our growth leaders. For me, this is one of the most interesting findings in the entire survey, especially as my background, I started in sales, I end up in marketing. And so it's always interesting when my disciplines come out on top. These businesses aren't simply telling us they need more capital or more people. They're telling us they need greater capacity to take what they already have to market. On top of this stat, our report also states our growth leaders, 63% of them want to grow their market share. 50% want to expand their product or service offering. 43% want to develop a new customer base. And 40% want to develop new products or new services. Those aren't principally financing objectives, they're commercial execution objectives. And there's some interesting external evidence supporting this. So Gartner, the great research house, found earlier this year in 2026 that organizations collaborating across sales, marketing, and service on enablement content are 2.4 times more likely to achieve strong commercial growth. Having people isn't necessarily the same thing as having the capability to drive growth and new opportunities. So, complexity. Growth itself creates complexity. When we look at what these businesses actually intend to do, they're not simply looking to sell a little bit more of what they already have. As I said, half want to expand their products and services, 40% want to develop new products, and a quarter are looking at M&A. So let's look at M&A as an example for growth. As we know, there is plenty of capital currently for deployment. That may change over time. But capital needs somewhere to go, and private equity has an abundance at the moment waiting in the wings. The middle market presents opportunities. As mentioned, 25% of Nexia respondents identify M&A as a growth strategy. So this creates demand for suitable targets. And a recent EY report finds that nearly 40% of European family businesses expect an ownership or leadership transition within a decade, but only 30% have a formal succession plan. This is possibly an opportunity for growth and consolidation. Succession could increase the supply of those targets within the next decade. Private capital doesn't necessarily mean, as you know, selling the business outright. Increasingly, we're seeing founders bring in a private capital partner, retain an interest in the business, and use that investment to fund the next phase of growth, including acquisitions. In fact, recent reports from the UK by KPMG in their 2026 half-1 private equity analysis says that bolt-on acquisitions represent 62% of mid-market PE deals, up from 56% last year. And minority investments accounted for another 17% of the total deal volume in the first half of 2026. So what does this look like realistically? So say a successful 80 million euro family business in a fragmented sector, that could mean becoming a platform that acquires competitors rather than necessarily being the company that gets acquired. But completing the transaction and having the capital do this isn't the same as creating value. Acquisitions and consolidations have to be integrated, professionalized, and grown. That requires management capability, technology, people, commercial execution, and operational improvement. And that's where specialist advice comes in, because it's important to have specialized advice to navigate complexity. But M&A is only one example. 40% of respondents identify international expansion as a growth strategy. Whether growth comes through acquisition or organically across borders, it creates complexity. Tax, regulation, people, technology, financing, and market entry questions that businesses may not have the capability to manage entirely in-house. Capital can fund growth, capability determines whether it creates value. So let's look at advice. So what I find interesting is the gap between the complexity of what our survey respondents are telling us that they want to achieve and the external expertise they're using to achieve it. 25% of our respondents use no external advisors at all. They keep it all in-house. And only around 1 in 3 businesses use any individual type of specialist advice. Compare that with private equity. These are sophisticated investors with capital, experience, and internal teams, yet they routinely bring in external specialists throughout the investment lifecycle. As you can see the stats on the slide, 90% are using third parties for due diligence work to identify any strengths and weaknesses of the target. 56% use them for post-integration value creation, and 42% use them for more general integration of 2 entities, so technology transfer, all that kind of difficult work. So perhaps using external expertise isn't a sign of lacking capability. For sophisticated investors, it's part of the capability, having a strong bench of advisors you can bring in at the right time in order to make value on the investment that you've made. And I think this brings us nicely back to our central theme. There is ambition in the middle market. There is capital currently floating around, but as growth becomes more complex, success depends on having access to the right capabilities, whether they sit inside the business or not. Using external expertise isn't a sign of weakness for a business. It's a sign of good leadership and the understanding of the assets you have in-house. Okay, so what do the results show? I'm going to try and bring this together in a diagram. I'm going to pretend that I'm a LSE MBA professor. This type of flywheel might, of course, already exist at Harvard Business School or on an MBA at the LSE, but this is what the research shows us. There is ambition. Businesses want to grow. There's capital available to fund that growth, but capital ambition need capability to turn them into results. And as businesses grow through new markets, acquisitions, technology, or new products, they inevitably create greater complexity. That complexity creates capability gaps, and that's where specialist advice can become an important part of successful execution. So from specialist advice and successful execution, that drives more ambition for the future growth objectives of the business themselves. And so the wheel continues, not necessarily ad infinitum, but in the natural life cycle of a business. However, there is one major part of the picture that businesses cannot control, and that is the external environment. Our respondents identified that economic climate and political environment are the 2 most significant external factors shaping their growth. And that's where I'd like to hand over to Sol to take us outside the business itself and to look at the macroeconomic and geopolitical forces that are reshaping the environment in which these growth decisions are being made. So with